Volatility is one of those concepts and terms which is immensely difficult to pin down, and indeed is often used incorrectly. In simple terms and from a common sense perspective, volatility describes movements, actions or events which are considered to be sudden, and by implication, these actions and events are extreme, and so bring distance into the volatile equation. The two principles of volatility purely from a common sense approach would therefore suggest a sudden extreme movement could describe the verb volatile. It's important also to remember that volatility is non-directional. It says nothing about the direction of any price move, either higher or lower, and in fact the market may simply move sideways in a whipsaw phase. But in a common sense way, volatility is simply a statement the market has seen sudden and extreme movements in price. In other words, time and price have been compressed, and this, in a sense, is really what volatility is all about. It's the constant compression and expansion of time and price that leads to the constant changes in volatility in the market. You can think of this like an old-fashioned bellows, sucking air in slowly before driving it out fast to fan the flames of the fire. Now, from a mathematical perspective, there are generally four concepts that you will come across when considering volatility, and these are generally standard deviation, variance, mean, and average true range. And it's the last of these, average true range, that we're going to look at when we come to consider the quantum volatility indicator, how to use it, how to apply it, and how to take advantage. Volatility is a double-edged sword, a little bit like leverage. It can be both good and bad. If we're on the right side and we understand price action, we can take advantage of volatile moves. Equally, if volatile price action catches us out, it can be our worst enemy. So having a clear view on volatile price action when volatility arrives in the market and taking advantage of it, or indeed staying out of the market for the time being, are essential elements in the trading arsenal. And this is where the volatility indicator steps in. So let's take a look at the quantum volatility indicator in action. And here we're using the euro-dollar on a 5-minute time frame. We have 4 examples, and as you can see, each time the indicator is triggered, it prints a small purple arrow to the top and bottom of the candle. We have one example at the bottom left, a down candle. Towards the center of the price action, we have 2 consecutive indicators fired, both to the upside. And finally, up at the top right, again, we have a widespread up candle with the indicator triggered with the small arrow to the top and bottom. So for each of those 4 candles, we know that we've had a period of volatile price action. What do we do and why does this happen? Well, volatility comes into the market for various reasons. There are many different reasons, but one of the primary ones is whenever a piece of economic data is released. The fundamental news comes and goes all day long, and the market will react accordingly. Now, as the price action jumps on the news, typically what happens, and the first example here is a classic, the market has fallen sharply, the indicator has triggered, and what's happened? The price action, the subsequent price action, has moved back inside the spread of the candle. And this is what makes this indicator so powerful. It's called a trap move, and it happens all the time. The insiders, the market makers, the big operators, call them what you like, they use the news to manipulate the price constantly. Traders will be looking at that 5-minute candle, thinking this is a quick and easy way to make some money to the downside. They'll be jumping in on the news. It's a surefire bet that the market's going to fall further. What happens? The market promptly reverses and moves back inside the range of the bar. This happens repeatedly, time and time and time again. It's a trap move. It is designed for one purpose and one purpose only, to get you on the wrong side of the market. And the further the market retraces, then the weaker those positions become, and eventually those traders close out at a big loss. That is what this indicator is doing. That's the primary purpose of this indicator. If you're not in the market, it is a heads-up warning, a clear signal volatility has come into the market. Expect the market to do one of two things: either retrace within the spread, in which case you stay out, you wait, or in the second example, you wait for confirmation of the indicator with an advance in the price action. In other words, once the price action has moved away from the spread of that particular candle associated with the indicator, then you can assume, nothing is guaranteed, but you have a pretty good idea that the market, this is not a trap move, and the market is going to continue in the direction of travel. In other words, continuation of the trend first signaled. In this example, the first indicator was triggered, and then we had another volatility indicator came in immediately afterwards. But nevertheless, the price action, the second candle, was confirming the first, with the price action moving well clear through and away from the original spread of the candle. And that is what you're looking for. Because when you have volatile price action, it will either be a trap move, in which case the market will retrace, and it's a question of being patient, or it will duly be confirmed with a continuation and move away from the original price action. And you can then consider taking a position in the market if you're not already there. Finally, at the top right, you can see we have another example of a trap move. What happened here? We've had a nice uptrend through the session. The market has then spiked quite rapidly. The volatility indicator has triggered because the price action has moved outside the average true range for this particular instrument and this particular time frame. What's happened? The market has retraced back inside the spread of the candle. So if you weren't in the position at that point, then you would be waiting for that candle to be confirmed. And in this occasion, it retraced back in because it was a trap move. Now this raises the other point. Obviously, if you have a position in the market and the volatility indicator is triggered, then you have a decision to make. You wait to see what the price action is duly telling you. If it's moving in your favor, terrific. If not, it may well be time to exit, but at least you have confirmation that you've had volatility, and given that you've had the volatility indicator triggered, you will have a pretty good idea of what you're looking for. You're either looking for a confirmation and a move away, which may be in your direction or it may not. Alternatively, you're looking for price action to retrace within the spread of the candle and not for the trend to continue. It's a very simple indicator, but immensely powerful. And it really brings the volatility issue into sharp focus and will help you to identify those periods when volatility is in the market and to take advantage accordingly. Volatility is both good and bad. You want to be on the good side, and this is a great little indicator to help you see it and to take advantage accordingly. So thanks for watching, and see you again soon.